All right, thank you, DJ Nick Bradfield, for those tunes to get us excited about our town hall. My name is Liz Marion, and I am the Director of Events here at Bunker Labs. And I want to welcome everyone to our Market and Consumer Trends Town Hall. It is brought to you by Barclays, our partner for this event, and MetLife, of course, who brings all of our town halls virtually to you, our audience. I want to welcome everybody for this unique and really timely topic. We were so excited that Barclays wanted to bring this to our audience and to our military connected entrepreneurs. So just a couple housekeeping things, and then I'll pass it over to Nick to get started. If you want to ask a question, you can do that at any time by dropping it into the Q&A box, which is the two chat bubbles at the bottom of your Zoom screen. If you just hover over the bottom, the panel will pop up so that you can ask a question, and then we will be able to answer those live at the end of our session. If you want to chat amongst yourselves, please do so in the Zoom webinar chat. That is open for all of you. We do encourage you to actually drop your LinkedIn URL there so that you can connect after the event with one another. And if you have anything that or needs from the Bunker Labs staff or HQ, please let us know. And if we can provide any resources, we will. I'll also ask Shelby to drop the bunkeronline.org URL in the chat, because that is our online community where you can connect at any time. And so without further ado, I am going to pass it over to Nick, one of our ambassadors in New York City, to get this started.
Liz, thank you very much. Very excited to get this kicked off. We have two impactful guests joining us today to make sense of the impacts that we've all been experiencing here in 2020 and what that means for markets, investments, and business opportunities. First, we have Drew Colmer, who'll be speaking with us on investor confidence. Drew is a director in the Equity Capital Markets Group at Barclays, focused on technology, media, and telecommunications, as well as convergent sectors such as fintech, insurtech, proptech, and consumer tech. Mr. Colmer has 9 years of banking experience, having joined Barclays in 2011 as an analyst in the equity sales trading. In 2013, Mr. Colmer transitioned to the Equity Capital Market Group. During his career, he has worked on a variety of equity-linked and M&A financing transactions for both public and private companies. Mr. Colmer has a BA in political economy from Yale University. And second, Ballerina Urici will be speaking to us about consumer and labor market trends. Ballerina is a director in the U.S. economics team at Barclays. She is responsible for writing thematic research and presenting her views to Barclays clients across asset classes and countries. Her main responsibilities include forming the firm's near and midterm inflation forecast and assessing the housing market outlook. Before joining the U.S. team, Ballerina was acting chief UK economist for Barclays, based in London. She was responsible for developing the firm's view on UK economy, including monetary and fiscal policy. Prior to joining Barclays in 2010, Ballerina worked for Thomson Reuters in European economist in London. She was part of the government economic services for the UK and worked as a development economist in Malawi. Ballerina holds a Master's of Science in Economics from London School of Economics and a Bachelor's of Science with honors in Economics and Politics from the University of Bath. Drew, Ballerina, welcome. Thank you for joining us today.
Thank you for having us.
Very excited.
Thanks so much for having us.
You got it. So we'll dig right in here. I imagine we have quite a bit to talk about in a short amount of time, given the events of 2020. How do we start this conversation? What are the terminologies, the frameworks, the things that we should be thinking about? You hear words like acceleration of markets and deceleration of markets. How do we start this conversation? Ballerina, we'll start with you.
Sure. So I can cover the economics part, and let me just say, what a year. We had probably the strongest and biggest negative shock to economic growth in modern US economic history. GDP fell by more than 30%, quarter on quarter annualized in Q2. That's We have never seen something like that before. The unemployment rate spiked to double digits within a month. Consumer spending fell off a cliff. Markets were jittering. But then, in response to this unprecedented shock, I have to say the policy response has been one to match this shock. We had the Fed step in very quickly to support markets and to stop those market jitters. And then we had the fiscal policy going in with the stimulus checks and the unemployment insurance benefits that really supported the household balance sheet. So then we had that period in Q2 where demand collapsed. We were all forced to stay at home, save, and not spend. Once it was safe again to go out there, consumer spending came back with a vengeance in Q3. So this is, I think, what people are talking about when they think about acceleration. We had this big drop in demand and then an acceleration in Q3, and I think that was possible because the economy opened up, but also because household balance sheets were well supported by the policy response.
Yeah, very good. How what are the thoughts on how these household balance sheets are driving driving local economics, impacts on businesses?
Yeah, so Nick, I guess first I'd say thanks to the Bunker Labs team for having me today, and for all of the service members that are in the audience. Thank you to you and your families for your service to the country and the sacrifices that you've made. So I just want to say it's great to be with you guys today, and please, as the team mentioned, feel free to look me up on LinkedIn or connect in any capacity. Happy to try to help any way professionally I can. But I think, to build on Blarina's point, as you think about the trends and the different accelerations that we've seen as a result of the COVID pandemic, back in March, we were all trying to adjust to the new reality at home with our families, balancing work and kids and elderly, etc. So everyone was just trying to figure out their own situation at the same time. Investors nervous about the market outlook were fleeting out of risk assets, trying to move into cash or more defensive positions. And corporations and businesses at the same time were making very difficult decisions around whether or not to furlough folks, cut wages, layoffs, cutting budgetary items, reducing CapEx spend, et cetera. So it was just kind of a very difficult time for people to assess and make any sense of what was going on, right? I think what we've seen since the market has stabilized and as the government has acted both with fiscal stimulus and the central bank with more monetary policy, accommodated monetary policy, is investors have really honed in on a couple of trends that have accelerated through COVID. And I think the way we bucket it is between COVID acceleration trends for the consumer and COVID acceleration trends for businesses on the enterprise front. And if you think about it on the enterprise or business front, it's really a function of investors thinking about a basket of stocks or a basket of companies that theoretically would be COVID beneficiaries. And it's somewhat terrible to say that because you don't want to think that there's any beneficiaries through this. But the trends that we're seeing on the business side, right, and the focus and investment is around companies enabling digital transformation. So effectively allowing businesses to empower their workforce to work on a distributed basis, to utilize cloud solutions, to enhance workflow management, and just effectively take old legacy processes and digitize them and bring them into the new world. Two is collaboration services. We're all on Zoom today. I think there's been a big focus on enterprises and how we work smarter, how we collaborate better, whether it's with video tools or with text tools, messaging tools, et cetera, or documentation sharing tools. And then lastly is really on a security front. As you think about people working more on a distributed basis, work from home, there's a whole new set of vulnerabilities and threats that businesses have been exposed to. And thinking about how to defend their enterprise, how to defend against endpoint attacks, how to defend against more potential just broader vulnerabilities. So those are where we've seen a lot of investment dollars flow and trends accelerate. I'd say on the enterprise side, on the consumer front, and going back to the health of the consumer balance sheet, it's probably not too much of a surprise. There's a few categories that really experienced a fairly material lift through COVID as we adjusted to the shelter-in-place dynamic, particularly around deliveries and e-commerce, right? So as we were shopping for groceries online, companies like Instacart experiencing fairly material uplift in demand for their products. Companies like Chewy that do deliver pet e-commerce, pet products and services online. The level of adoption for just broader e-commerce really explode. The focus and use of streaming, whether it was Netflix or Spotify, as we adjusted to our new reality. Also Peloton, right? The home fitness phenomenon that's come as people aren't necessarily able to go to gyms and utilize facilities. Video games and telemedicine and telelearning. All of these trends have kind of accelerated consumer adoption, and where investment dollars and investors broadly continue to focus and think about opportunities.
Yeah, excellent perspective. Thank you, Drew. How is this all connecting to the individuals, the consultants, the contractors, this gig economy that's kind of developed over the past number of years? As a lot of us have kind of shifted to working from home. Any thoughts or perspective either of you have on how these individual and in the gig economy have been impacted?
I can jump in and start, and I'm sure Drew will have his thoughts as well. But basically, early on in the pandemic, we saw a critical group of industries that were most severely affected by the pandemic. And I would say the services industry, of which the gig economy workers are part of, was one of the worst hit. So we saw the unemployment rate among these workers being particularly high. I would say the inclusion of gig economy workers in the CARES Act was crucial to support these families and these workers. And I think that helped to a large extent. Now, as we are moving into the recovery phase of this recession, we've seen employment numbers among this gig economy workers improve gradually. We don't have granular enough data to know what the particular balance sheet position and income position of these workers is, but we can see the aggregate employment numbers, they're improving. But I think what this pandemic is bringing to light is a need to support these workers. So now we're seeing moves in states such as California that are passing laws to support and to protect gig economy workers, to give them benefits as if they are full-time employees. And I think this is raising awareness, and I expect that there will be a shift in the way that gig economy workers are integrated into the broader labor market.
For sure. Drew, any thoughts yourself?
Yeah, it's interesting because there has been, a change in demand for certain services through COVID that has benefited or created more opportunity in the gig economy. But at the same time, it's unfortunate because it puts people more in a potentially critical or risky or dangerous position, right? And they're trying to make that trade-off between the economic opportunity and their own safety, right? So again, going back to some of the delivery options, you've seen Instacart aggressively hire. You've seen Uber Eats and DoorDash and platforms that are allowing consumers to not necessarily have to venture as far outside of their home and continue to try to take advantage of more seamless services. Seeing uptick in the opportunity, but you obviously have to balance that against again, the public safety risk, but then also a slight change in consumer habits around ride hailing and how that's impacted certain transportation-oriented gig economy platforms like Uber or like Lyft. But we've slowly started to see the utilization and uptick there as well. The one other area, and this goes back to some of the trend that we've seen on the enterprise front with digital transformation, there's marketplaces that help connect companies with human capital talent
Sure.
focused more on the IT front. So being able to deliver more tech-like services through an outsourced platform, whether it's Upwork or Fiverr. And you've seen, as these businesses have had an expanded need to transform digitally, get it online quicker, improve workflows, they don't have necessarily the right IT resources in-house. And they've gone and engaged with, third-party contractors to help facilitate some of that work.
Yeah, absolutely. You think the whole platform economy is going to see some acceleration from all this?
Yeah, it's interesting, right? I think when I think about a platform and platform tech in our universe, the name that always kind of comes top of mind is a company like Shopify.
Yeah.
Which is really oriented towards small and medium-sized businesses that are trying to establish an online footprint to help manage their e-commerce store. And clearly that was fairly critical as shopping went all online through COVID, and has only really continued to accelerate. But the interesting thing about Shopify, right, is that it's a platform that's meant to empower SMBs more broadly than just online. So trying to help them with their integrations with other parties to help facilitate marketing campaigns, to help facilitate managing payroll, managing loyalty. You name it. They're just trying to build out and try to empower these businesses to be more successful. So if I think about a platform business like that, I think the value that they're providing and contributing is only just going to continue to expand.
Yeah, absolutely. Great point. Any thoughts you guys have on?
Talking, Nick, sorry to jump in, but since we're talking so much about online and platform shopping, and I wanted to provide a little bit of color of what happened with aggregate consumer spending during the pandemic and what the trend was for online sales. So we monitor something called retail sales, which is basically all the money that US consumers spend on goods and services. We saw that from February to April, the share of online retail sales increased by about 10% to 18%. It was a massive shift. This 8 percentage point gain takes decades, even with the recent accelerating trend in online shopping before the pandemic. Since then, once the physical stores have opened, that share of online shopping has dropped from 18% at its peak to 14%. So what we're seeing is, of course, an acceleration of the shift towards online shopping that has been going on for some time, and these concerns about health and safety are making that grow faster. But when we look at these trends with our research colleagues in credit and equity, what we're thinking is that we're not ready to declare the end of in-person shopping, because we saw that as soon as we were feeling safe and emboldened to do so, and as soon as stores opened, we saw in-person shopping volumes pick up. We also saw that places like bars and restaurants, which had been a particularly weak spot during Q2, as soon as they were able to reopen, people returned to them. So I think these dynamics have been very interesting for us, just to think about this effect from the pandemic, how much of this is going to be temporary and how much of it is going to be long-term, and the changes that could come once we have a vaccine, which here at Barclays, we think it's probably going to happen, widespread use of it sometime in the first half of next year.
Yeah, excellent point, Lorena. I really appreciate you sharing that. I think for those entrepreneurs that are looking at, starting or have started physical good companies and benefit from that personal experience, it's great to hear that opportunity potentially still exists in the market. I know that's been a scary thought for a lot of people. I can also say personally, it's great to hear that we have that continued desire to connect and see each other in person. That's been I think the most challenging part of the disconnected feeling from coronavirus is having to see each other through screens all the time. But great to hear that. Thank you for sharing that. How are you guys thinking about global supply chain disruption? I know we've seen disruption in getting iPhone parts. We've seen delays in all sectors, really. how is the global economy responding to that disruption? Are we anticipating any future disruptions in those areas as there's a potential second wave coming? What are your thoughts on those areas?
So I would say that there have been instances and pockets where this has been a real issue. Early on in the pandemic, food processing in the US was a problem, especially around the meat processing factories. And it was incredible to see for a professional economist. This was a textbook example. You have shortages, and then you have price increases. So food inflation really shot up. We're seeing something similar with used car prices. There is intense demand at the moment. There isn't enough supply in the pipeline. There were some disruptions during the pandemic to auctions for used cars. Inflation is going through the roof in this market as well. So these dynamics are there, but I think they have been focused in some parts. And my general conclusion about the broader US economy and the global economy in general is that supply chains have been surprisingly resilient, because here we are with most of us forced to work from home with so much uncertainty about when factories would reopen and so on. But businesses have been so resilient, they were able to come back and produce. And we had, I mean, one anecdotal evidence and experience is if you use online shopping with Amazon, we had those crazy delays in the second quarter, but now we're back to doing business as normal. Yep. If you were trying to do online shopping for food, those April, May were pretty tough to even find a slot, but now everything is back to normal. So my general conclusion is that we've been surprisingly resilient. I've been really impressed with how quickly businesses have been able to adapt to this situation, so that now activity is starting to feel not entirely normal. We're still not back to doing this type of event in person, sure, but things have worked out.
Any thoughts on, if anyone's done any food shopping lately, you can't help but notice the cost of the shopping cart of groceries is easily 30, 40, if not 50% more expensive than it was before all of this. Is that related to the disruptions in the supply chain? I noticed we still can't find paper towel regularly in the food store. We still seem to be out of certain things. How is all that connected? Are there business opportunities that entrepreneurs should be kind of looking at in those areas? What are your thoughts on what's driving that? And is it bigger than just the grocery store?
I think there are opportunities there. There has been a shift in consumer expenditure trends. So a story we like to tell here at Barclays is the story of the great nesting of the US consumer, where we are reshifting our expenditures away from services. We're not going out as much as we used to do. We're spending so much time at home, and we're working really hard to improve those home environments, because we need that. We see that crack in the wall every day now that we work from the office at home. So we need to fix it. And we're thinking of other ideas to improve our home. So what this has translated to in terms of aggregate economic data is a lot of consumer expenditure on capital goods, on durable goods, I should say. So if you looked this morning, we received Q3 GDP data. When you looked at consumer spending for Q3, these goods, durable goods, increased by 88% quarter on quarter annualized. That's staggering. So it seems to me like this shift towards durable goods and away from services represents an opportunity for people. And also we have this long-term trend over the past decade or so where people like to buy stuff that is produced locally to support the local economy. So a combination of that trend with the fact that we're spending more of our dollars on durable goods, I think it's a good opportunity for this part of the economy, and hopefully bring some small-scale manufacturing back to the US.
Yeah, very good. Drew, what about on the investor side? What is the sentiment been overall as for companies that perhaps aren't directly connected to those acceleration areas? Have investors kind of dropped off entirely in those areas? Are they just kind of in a wait and see mode? Where are the thoughts there?
Yeah, it's interesting, right? Because if you think about the broader equity market, right, and you just take a step back, it's a little hard to reconcile the bifurcation that's existed, or what feels like exists, between the economic backdrop and the prevailing valuation or stock prices, right? So I think there's a one interesting point to kind of peel back the layer of the onion on there, and it's just to remember, companies in the S&P, it's now up 7% year to date, roughly. The companies in the S&P represent the largest companies in the U.S., right? They have access more broadly to cheaper capital. They're better insulated to withstand these types of macro shocks that we've seen. But what's important is you think about the makeup of the S&P 500. 23% of the index is actually comprised of Google, Apple, Amazon, Facebook, and Microsoft alone. And those stocks collectively, as of last Friday, were up around 49% year to date, with the residual, call it 495 companies, effectively flat on the year. So, just to the point in terms of where money has flown, where money has cycled. There's obviously certain areas of the economy that are struggling more right now, in the travel, leisure, hospitality space. I think there is a view, going back to Belina's point, that as we progress through the pandemic, as the vaccine becomes more widely available, that we will see more of a return to normal in 2021, and that's where people are looking out to, and thinking about a normalization. But for the time being, there continues to be kind of clear winners, and everybody else, right? So it's I wouldn't write it off, but I think we hopefully will start to see more of a broadening of focus across the market, as the reopening trade and as the economy begins to reopen, slowly but surely.
Yeah, very good. As a large portion, including all of ourselves right now, as a large portion of the workforce is working more and more from home, what are you guys seeing as the future of office spaces? Has there been a slight migration back to offices, and what has that cascaded into the markets and the economies that are built around offices?
Here at Barclays, we wrote a report about this not very long ago. Actually, a few weeks ago, we wrote a report about the future of real estate, and we split it between office space, retail space, and homes. And we can discuss the housing market also if the audience is interested, because that's looking really strong, very, very strong at the moment. But the idea is that we're probably going to be in this environment of working flexibly for the foreseeable future. Lots of people have started to return to their offices. Here in the US, our colleagues in Europe tell us that it's happened there maybe with an accelerated pace. But offices are keen to have people back in one place. I think part of the reason why working from home has been so effective during this pandemic is that we had those strong relationships that we had built when we all worked together, and we had those connections. So it's been a bit challenging for people who just start working and they have to do everything virtually. So I think the future of the office is there, but our working arrangements are likely going to look different, where we will want to commute fewer days a week, and so we may work from the office 3 days and from home 2 days a week. And we know now that we can be productive with the technology we have, and we actually can be more efficient. I used to do these client trips where I used to fly to California for 3 days, and I would drive in each city, and sometimes the Bay Area is sprawling. We would spend 1 hour going from one client to the other. I can do those meetings now in a day or two or a day and a half because I don't have to commute anymore. I do everything on Zoom. It's more efficient. And so we are learning. Things will change. I think there will be ripple effects, as you said. There will be repercussions for those cities or businesses around the office space. So we probably will not have the same concentration of small shop restaurants and so on around offices if people are going to spend less time and less money eating out going forward, simply because they'll be working from home more. But I think, so it's going to be an adjustment, but I don't think it's going to be as drastic as we're not going to have any more offices in Manhattan, because people are still keen to get out of the house and to see their colleagues.
Yeah, absolutely. Great point. How about go ahead, Joe.
I was just going to say, as a New Yorker,
Yeah.
I really hope we eventually find our way all back into the office at some point.
Yeah, I'll second that. Absolutely. We had an opportunity to get into the office, a few of us last week, and it was just great to see people. And to Blorina's point, some of us had never met each other in person before, and it was a great feeling, a great bond to just have that connection. And so, yeah, absolutely, I agree with both of you on that. We talk about opportunity recognition in entrepreneurship. I love to always go back to Jeff Bezos's recognition of originally with Amazon, the transition to online businesses, and the question he asked himself: what product, what SKU could potentially benefit the most from that? And that's ultimately where we came to books and expanded beyond that. And I think the second iteration of opportunity recognition that he displays really well was understanding how to deploy the platform, if you will, as an opportunity for other entrepreneurs to come onto the platform and sell. So we have kind of those two main trends, right? You have online was the original one, then this platform. Are there any other areas that you guys are seeing in that trend? Any other major trends that could impact the next opportunity, the next scale for those that are really focused on opportunity recognition? Any thoughts there?
I'm happy to share two thoughts.
Yeah.
I think one is going to be around the continued evolution in payments, right? And we've continued to see the digitization and the move away from cash, right? It started a long time ago with the credit card, but we've continued to see more and more improvements made in money transfer services, and then also just in the ability to tap at checkout. And I think consumers are demanding more and more of that efficiency, effectively, just replacing the wallet with your cell phone and finding ways to be able to move and move money and transact more easily, more freely, more securely. Sure. So I think that's a very big component as you think about online shopping, right, and securing identity, but also in the new physical world. Amazon being the great innovator, and their Amazon Go shops that you can see now in San Francisco and Seattle, and even a few here in New York, where they're using different technology to recognize you in the store and the items that you take off the shelf, and you can just walk in and out, right, with a seamless experience and have all your payment credentials attached to your account to facilitate that. So I think payments on the consumer side, and also similarly even payments on the business side, is going to be very, very important, and continue to see a lot of investment and growth in that sector as people move away from legacy checks, writing checks with their suppliers, and really thinking about more of a digital supplier network for procuring and then also paying vendors. So I think payments is big, and then the other that might be applicable for this audience to some extent is, what's really been amazing to me is obviously the small business community is really just such the lifeblood of the U.S. economy, U.S. backbone. And there have been a ton of companies that have been started or founded now to try to make the life of a sole proprietor, or the life of a entrepreneur or a business manager for an SMB much, much easier. And I think it's an extension of most of those individuals, having a certain type of experience with a consumer product and saying, hey, if I'm running my business, I want to have a very similar type of experience as an operator, to be able to offload some of that burden, whether it's around marketing, again, payroll, bill payment, banking, lending, etc. So I think that there's it's such a massive audience. It's fragmented. There's real value that can be delivered. I would encourage the folks on this line. If there's something that you're finding difficulty with in operating your business, seek out these tools, because most of them exist. And if they don't, it's likely that others in your seat are having similar challenges, and it could actually create an opportunity for you to solve and build a solution for SMBs more broadly.
Yeah, very good. Great points. Lorena, any thoughts?
I think Drew covered them.
Very good. So we have a question here in the chat. More on the real estate market. Any ideas how long mortgage rates might last? And will this continue to keep demand strong?
Oh, that's a great question.
Yeah.
I can have a go at that. So mortgage interest rates, the way we think about it in our team here at Barclays, is they're directly linked with long-term interest rates for US government debt, so 10-year yields, which is also responding quite strongly to Federal Reserve interest rates. So when the Fed lowers interest rates, as they did very sharply in March, then long-term yields decline and mortgage interest rates decline. Now, on our expectation, the Fed is so focused on supporting the economy, and so they will maintain interest rates close to zero for at least another 3 to 4 years. And once they start, so it will be very similar to the way it was during the last business cycle, where they stayed put for a very long time. And once they start increasing interest rates, I think they will do so very, very slowly and very, very gradually. So what this means is we could expect to have mortgage rates so low for a prolonged period of time. Now, if there is a dramatic increase in fiscal spending, even more so than recently, and if markets start getting a little bit jittery about the prospects about the deficit and debt, then even if the Fed does not increase interest rates, long-term yields could increase, and this could be a risk to higher mortgage rates sooner than our monetary policy expectation. And now, what is the effect of this low mortgage interest rates on housing demand? Well, they've been a key factor in supporting strong housing demand during this recession. The other one being this increased demand that people have for more space and the lower need for living close to their offices. So we're seeing a big shift from high density urban areas to less densely populated areas. What this has done is to increase home sales and demand for homes in those areas. And we think this is what's driving transactions recently. We've done some work on this with our high frequency data team here at Barclays. And because of mobile data and mobility, we are able to track in real time where people are migrating and how many people are leaving cities and coming back and so on. And what we found is that there has been a net migration out of densely populated areas of about 2.5% just in the first 9 months of this year. Compare that with 0.5% in 2019, the whole year. So it's 5 times bigger in less than a year. It's in demographic terms, this is a pretty big shift. So we have this support, strong demand for housing that is being driven by low interest rates, but also by this demand to shift to areas with more space. And we think this is going to play out in the housing market for the next 2 to 3 quarters at least.
Yeah, very good. We talked before a little bit on, I don't want to call it price increases, particularly in industries where there's been supply chain disruption. Are any of those price increases related to a potential inflation issue, or you think it's completely on the supply side?
So I think that's a great question. It's the $1 million question. Lots of investors are pretty excited about the prospects of inflation. I think that will have a direct effect on equity markets as well, as Drew can tell you in more specific terms. The way people think traditionally of inflation is it can increase because labor markets get very hot, meaning the unemployment rate is very low, so it's harder to find workers. So then wages will increase faster, and this will lead to higher inflation because producing things is more expensive now, but also people have more money, so they can buy more. So that strong demand increases prices. We think this element is not there at the moment. There is a lot of labor market healing that still needs to happen in the US economy. The unemployment rate is 7.9% compared to close to 3% before the pandemic. But there is this other element of strong fiscal policy and very accommodative monetary policy that can lead to hyperinflation. And I think this is where people see the risk. Our view at Barclays is that inflation, so I know that there are some portions of our day-to-day basket where prices are increasing a lot. For people who rent, that's the portion of the market that has been increasing the most. But when you look at the aggregate inflation rates in the US and in DM economies, in developed economies globally, it's been fairly subdued. So actually the challenge for policymakers has been not to get in a deflationary situation like Japan. So for us, those structural forces have been quite powerful at keeping inflation low. So we do not see imminent risks to hyperinflation, but a less independent monetary policy authority like the Fed and fiscal deficits out of control could exacerbate. This is not part of our baseline scenario. We don't expect that to happen, but if we could name some risks, these would be it.
Yeah, very good. You've eased my concern somewhat. Thank you. Let's see, another question. How do small consumer brands stand out in this digital environment without major advertising budgets? That's a great question.
So, yeah, it's in the early stage of the lockdown when companies were reassessing marketing budgets. You obviously saw a pretty material clampdown in spend, and it actually created somewhat of an interesting dynamic on the larger digital ad platforms like a Facebook, like an Instagram, where there was actually less people competing for space. So the price actually went down and it wasn't as competitive. So it actually allowed certain brands to more efficiently market on a wider reach platform than they probably could have done pre-pandemic. I think as rates have bounced back and the level of advertising interest on those platforms comes back, it's obviously a little bit of a trade-off. But I think interestingly, where we've seen people have success with advertising spend are on some of these newer platforms. Obviously, TikTok has been in the news and headlines for a whole host of reasons. But as you think about that as a new digital content platform to engage with a younger generation of consumers, there's a lot of interest there. But it's much more on I'd say on the discovery side of the brand than necessarily trying to drive purchase and intent to drive revenue for brands. But the one other piece that I come back to, I think that's really worked well, is just organic marketing and trying to connect with consumers in more of a real way that establishes a human-like connection where possible. There are a lot of DTC brands out there that compete with one another, and a lot of it is for the same space and the same eyeballs. So if you can find interesting ways with organic content to create more of a human connection, I think that's what's, at least from my perspective, resonated with a lot of consumers. Yeah,
100%. And I think that's a lot of what we see in our local bunker meetings amongst the cohort that we all work with. This is very much the time for individual entrepreneurs to create their platform, whatever channel, whatever distribution channel you choose. But Sabrina, feel free to reach out or message me directly if you want to elaborate more on that. I can certainly connect you to resources that we have in the bunker community to support that already. But that's very much a day-to-day conversation. And I think a lot can be done to create your personal brand, to create your company brand in coordination with that, and be the independent driver with small budget. It's very possible. So guys, with our attention to time here, we've gone through much faster than I expected. Thank you both so much. This has been very educational, very impactful. I thank you both for sharing your work, sharing your thoughts. Thank you very much.
Yeah, Nick, absolutely. Thank you for having us and for hosting us.
Got it.
And appreciate the questions from you and the audience.
Thank you, Tiffany.
Thank you very much, everyone. It's been great being part of this event.
Ballerina, Drew, thank you both very much. Tiffany, we'll kick it over to you.
Well, this has been such a great education for me as well. I'm Tiffany Daugherty. I lead military and veterans outreach for the Americas for Barclays, and I'm just so thrilled that Ballerina and Drew, they both have very busy jobs within the bank, and they did not hesitate for a moment to connect with our military community and to share from what they know. And I know it was useful to me. I hope it was useful to you. Just want to tell you a couple of things. You'll get this information in the chat now, how to connect with me. If you have any follow-up questions to connect with the bank, you can contact us at mvo_USA@barclays.com. I'd love to tell you all the things we're doing with the military community, but for the sake of time, I'm just going to talk about entrepreneurs and how you can connect with Barclays if you're an entrepreneur. First off, we are a bank that is based in the UK. If you know any veterans that are looking, that are starting businesses or veteran business owners in the UK, I have them connect with our Eagle Labs team. We actually run 20 incubators across the UK, and I know Bunker is expanding globally as well. But here in the US, we're proud of a couple of really important things. One is more generally, not just for veterans, but we run a RISE program out of New York City for any business owners that are looking to get into or in fintech or financial services. And right now we are running some amazing programs for female founders and female innovators. We've invested a lot in that. We want to see more women in the C-suite. So please check that out at rise.barclays. And lastly, if you are procurement ready and interested in looking at supplier diversity programs, we do consider veterans part of our supplier diversity strategy at Barclays. So fill out a form with us. If you just Google Barclays Supplier Diversity, you'll find it. If you don't, email me and I will send that information over to you. But our purpose at Barclays is creating opportunities to rise, and we take that seriously. We're proud of that in the veteran community. The last thing I didn't mention is we're the founding sponsor of the Tandon Veterans Futures Lab out of NYU. So if you're in the New York City area, definitely check that out. Thanks so much to the Bunker team for having us today.
Awesome. Tiffany, thank you so much. I know we didn't give you too much time, but her email is dropped in the chat. So I encourage all of you to reach out to Tiffany if you have questions about that. Great resources and opportunities at Barclays as well for our veteran and military connected entrepreneurs. Nick, thank you so much for moderating this awesome conversation. I know that from the chat and from all the questions we got that everybody learned a lot and has a lot of questions. We'll probably reach out to you, Nick, as well to demystify a few more things. Drew and Ballerina, we can't thank you enough for just sharing your time, most importantly, and your expertise with the Bunker Labs community. So thank you all. And if anyone wants to reach myself or Shelby or Nick and has questions about our resources, you can reach us at townhall@bunkerlabs.org. Thank you so much.